Good evening, class, and welcome to our advanced taxation class this evening. Today, we will be looking at an important topic that is 90% of the time, if not more, featuring in your examination, and this is capital gains tax. Capital gains tax is an important topic that we have to reckon with. Now, I will be giving you the lowdown of capital gains tax that is sufficient for your examination. Now, let's get right down to business. Capital gains tax is a tax that is charged on sales of your capital assets. It means that when you sell an asset, you make a gain or you make a loss. You don't say you make profits when you are dealing with capital. It's only when you are dealing with stock, when you are dealing with your trading stock, that you can use the word profits. And then you can also use the word sales. When you are dealing with your assets, and if you sell them, now the technical word for that is not sell or sale. When you dispose them of, that means you give them at a price or even for nothing. But this time around, if you dispose them of and you make a gain, that means you have made a capital gain. Now, capital gains tax is computed on actual year basis. So it means that any asset you sell between January to June will be computed by June 31st. And any asset you sell between July to December of that year, you will need to compute on December 31st. So it is being done semi-annually. Due dates are 30th June for assets that are disposed of before on or before June 30th, and 31st of December for assets that are disposed of on or before 31st December. Now, the rate at which capital gains is charged is 10%. So when you get the gains from your assets, you charge 10%. Now you know that when you sell something and you want to make a gain, the gain is simply the amount the asset was sold minus the cost of the assets. That will be the gain. But let's look at the formula and see how we can compute capital gains. So the first thing to do is to get the cash received from the disposal of the assets. Now that means, let's say, for example, you have an asset that you disposed of and you receive cash for 10 million naira. Now that 10 million naira is the cash you received from the disposal. Now that's what stays at the top. Now you need to deduct all the expenses that are incidental to the disposal. So it means that all the expenses you incurred to get a buyer to buy these things from you. Let's say, for example, you did advertisement cost. This is an expense that is incidental to the disposal. You paid your surveyor fees, accountant fees. All these are expenses incidental to the disposal. Without those expenses, you cannot dispose the asset. So you need to deduct it from how much you collected from the asset. Now, let's say you sold the asset for 10 million naira, and you spent 1 million in order to get these things ready for disposal. That 1 million you will deduct from 10 million, you will get 9 million as your net cash received from disposal. It's just like your net sales, but this is net cash received from disposal. Now you still need to deduct two other things. The second thing you are deducting, because we've deducted one thing, which is expenses incidental to disposal, we need to deduct the original cost of the asset. How much it cost you historically to buy the asset. Now, we are not talking about revaluation here. Let's say you bought an asset for 5 million and the asset's current price now is 8 million. You don't revalue the assets. You use the original cost of the assets. That is how you know if you make a gain or not. So you bring the cost of the assets, then there is the cost of improving the assets. So it means that if you buy an asset, you need to make an improvement on it. Let's say you bought land and the land was swampy. You now have to put some sand to sand fill it. That is an improvement cost. Or you bought a laptop and the laptop is empty when you bought it. You now put operating systems, softwares, and operating system to make it functional. Those softwares become the improvement cost. So there are three things you are lessened from the cash you received. The first one is expenses incidental to disposal. The second thing is the original cost of the assets. And the third one is any improvement cost. Once that is deducted, what you have is your capital gains. This is the gain that you made from the disposal. Then you have to charge 10% of the capital gains as your capital gains tax. So that's easy. So it means that there are three allowable deductions to be made on cash received from disposal. Only three allowable deductions. The one of them is any expense that is incidental to disposal. The second one is the original cost of the acquisition of the assets. And the third one is any cost of improvement. Now let's take that down. Now we want to look at examples of capital gains tax. We'll be looking at four scenarios. In these scenarios, we are going to be telling you what is peculiar in these scenarios. We are going to be telling you what your examiner will be looking out for when he's testing this scenario. And we're going to let you know how you can identify which scenario will play out. So there are four scenarios that your examiner will come from when testing you capital gains tax. Now, the first one is what I call full disposal of an asset. Now, what it means is that you have an asset that you bought for a time and you sold the whole asset, everything. You didn't sell it part by part, you didn't sell it uh, on installments, you sold it once and for all and in whole. Now, let's see an example. This is the simplest, and I doubt if your capital gains tax will come in this form. But this is how you need to understand how to do capital gains tax. Now, example one, Malam Hassan Enterprises decided to dispose of a duplex in Ikoyi, Lagos, a property that was acquired in 1997 for 2,500,000. Now, as you are reading, what is coming into your mind? This 2,500,000 is the acquisition cost, because you see the word here, acquired. It was acquired in 1997 for 2,500,000. So 2,500,000 is your acquisition cost, the original acquisition cost. Now, they said it was disposed of. So they didn't tell you here that part was disposed of. They said it was fully disposed. All right. Previous tenants of the property vacated it in January 2000. So it was vacated in January 2000, right? A security man and a gardener were then deployed to the duplex for the purpose of looking after the property until it was disposed of. So it means that this security man and the gardener, they were taking care of the property, making it safe, looking after it until it was disposed of. Now, the property was eventually disposed of in June 2000. Now, what it means here is that the day it was disposed, since you are doing capital gains tax on actual year basis, the year of assessment becomes the year it was disposed. Now, because this was disposed in June, you will need to file your capital gains tax on or before June 30. And now we are told that the following details were extracted from the financial records of the enterprise. Now, what are these details? We have sales proceeds of the duplex. The sales proceeds of the duplex. So we are told that it was disposed of in June. This is how much it was sold for: 6,750,000. So that's the disposal, cash from disposal. Now we have cost of advertising the sale of the property. Okay, so that is an allowable expense because this is incidental to disposal. Insurance premium against the risk of damage to the property. Now, insurance is not going to be an allowable deduction. If you should know, anytime you are looking for um, allowable deductions, once you see anything insurance, you should not put it, because if eventually there is a damage to the property, you can make a claim on that. So any insurance premium, take note, is not an allowable deduction. The same goes to depreciation. Depreciation since January to June is not an allowable deduction. for capital gains tax. Now we have the security guards and gardeners wages from when the property was vacated to when it was disposed of, January to June 2000. Now that's allowable, 60,000. We have the cost of renovation. It was renovated in February 2020. Now you see, it was not renovated for rental purposes. It was renovated for improving the asset for disposal. The asset was vacated in January, renovation took place in February, and it was disposed of in June. So cost of renovation is an improvement cost. Then fees and commissions paid for the professional services of legal advisors, estate valuers, and auctioneers in connection with the sale. So these are expenses incidental to sales. Then transfer and conveyance fees. These are allowable deductions. Now you are required to compute the capital gains tax payable by Malam Hassan Enterprise. Now that's the question begging for answer. How do we answer this? Now here is the answer. This is the answer to the question. Remember the formula we gave? We said that you first of all bring the sales proceed from the duplex. We sold it for 6,750. That is how much we sold the assets. And now we are bringing it here. 6,750 is the sales proceed or the cash received from disposal. Then we need to deduct expenses incidental to the disposal. What are these? We mentioned cost of advertising the property. It was 37,500. We have the security guards and gardeners wages, 60,000. We also have the fees and commission paid to all these professional people in connection with the sale, 425,000. Then of course we have the transfer and conveyance fees, 75,000. Now when we add all of these, which we are doing now, when we add all of these together, let's add them together so we see 37,500 plus 60,000 plus 425,000 plus 75,000. We have 597,500, which is what we have here. We are going to remove it from 6,750,000. So let's say minus 6,750,000. Of course, it's going to be the other way around. 6,750,000 minus 597,500. And we are going to get 6,152,500. So this is what is our net sales. So if you look at it here, this is our net sales proceed from the disposal, 6,152,500. Then the next thing we need to do is to bring all the assets that are, all the expenses that are remaining, which is the cost of the assets being disposed. We were told that it was bought for 2,500,000, which is the original cost of the assets. That's what we have here. Then we have cost of renovation, which is the improvement cost, 250,000. So we add 250 to 2,500,000, we have 2,200,000 and 750 rather, 2,750,000. Now when we bring this 2,750,000, when we bring this 2,750,000 and take it away from 6,152,500, we are going to get 3,402,500. Now if we apply 10%, which is 0.1, you have 340,250. Now that's your capital gains tax. Capital gains tax is 340,250. That is as simple as it gets. That is your capital gains tax in the first scenario. So you see here, this is as simple as it is. When we apply this formula, this is the basic formula to be applied. So you will need to learn this formula and you will see how we will apply it in all the other scenarios. Let's get down to the question number 2. Octopus Engineering Company Limited bought a house in GRA Port Harcourt in 1992 for 1,200,000. Now this is the original cost of assets. We'll remember that. Now he bought it for letting. That means he bought it for commercial purposes. Now I want you to know that anything that you are charging capital gains tax on must be something for commercial purposes. So you don't expect to acquire a house where you are occupying it. If the owner is occupying the house, it is not for commercial purpose. And when you dispose it off, you will not need capital gains tax charged on it. Now, you've seen that the intent is for business when you say letting. Now, in order to upgrade the facilities, now when they say upgrade the facilities to improve it, so anything after this is an improvement cost. It spent 250,000 on various repairs. That is cost of renovation of the assets or improving the assets. In September 2002, the company sold the building. Now, because it was sold in 2002, the year of assessment for this capital gains tax is 2002. So as you are reading, you are underlining, you are getting insights. How much did this sell? The company sold the building for a sum of 2 million. Now this is the amount received as cash received from disposal. Now after incurring the following expenses, now any expenses you see under here is expense incidental to disposal. We have the solicitor's fees and stamp duty. We have the agent's commission. Yeah, once again, we have insurance. And you remember what we said about insurance? It is not allowable. Then we have income tax on rent collected by agents. Now that is another um, disallowable expenses. Now we have added another thing to our list. Anytime you see any tax of any form, tax of any form, is not allowable for any calculation of tax. So if you see withholding tax, you see income tax, you see VAT, you see any taxes, this is not allowable. The same too with fines, they are not allowable. So our allowable list is building up. We are building up our knowledge of disallowable expenses. I've told us a few today: insurance, depreciation, taxes of any form, fines. So take note of these because you may see them. Now, accountant fees. So if I were you, I'll be ticking good to those ones that are allowable. The ones that are not allowable, I'll just put a small X showing it's bad. I'm not going to use it. Now we are told to calculate the capital gains tax for the relevant year. Now we've said that the relevant year is 2002. 2002 is the capital, is the relevant year. All right, so sales proceeds from disposal, we are told is 2 million. 2 million is the sales proceed. Now, the expenses incidental to disposal, I've mentioned them. These are all of them here, except insurance and this income tax. These are the two things that will not feature. So the rest are featured here. Once more, we'll get our calculator. Let's calculate these ones here. We have 15,000 plus 29,000 plus 19,000, and that gives us 63,000, which is our expenses incidental to disposal. What do? We need to remove this 63,000 from 2 million. So we say 2 million minus 63,000, and that gives us 197, 1,937,000. This is your net proceeds from disposal. Now we need to remove two other expenses. Cost of acquisition of the asset. How much was the asset acquired? It was acquired for 1,200,000. And that's what we find here, 1,200,000. And now the cost of upgrade, we were told that it spent 250,000 on upgrade. So that's what we got here. So when we have 1,200,000 plus 250, we have 1,450,000. Forgive me, this thing jumps to this area. It's supposed to align by coming by the side. So, but this is where it is here, 1,450,000. Now you need to remove this 1,450,000 from 1,937,000. So 1,937,000 minus 1,450,000, it gives us 487,000. And now if we apply 10% on it, that's 10 divided by 100, that gives us 48,700. That is your capital gains tax. So it is believed that we know how to do capital gains tax. How do we know that this scenario is scenario one? You see that the whole asset was disposed of in full. So once you see that the asset is disposed of in full, Remember scenario one. What should you be looking out for in capital gains tax? Look out for how much you received. Look out for the cost of the assets. Look out for any upgrade. Look out for every other expenses that are allowable for incidental to disposal. Now we have scenario one. Okay, now let's go to question number three. Let's see how we do question number three. Quantum Leap Limited bought a block of flats in 2003 at Iyaganku, GRA Ibadan for 1,250,000. Now that is cost of acquisition because they say bought, acquired. These are the language they could use. It incurred incidental expenses amounting to 65,000. Okay, what do we call all these? It incurred incidental expenses amounting to 65,000. Because you see the word incidental expense, these are not expenses incidental to disposal. Okay, it could be incidentals to disposal. Yes, it could be. It could be. But we are not told. This statement comes right after the cost of the asset was mentioned. So it could be that these are costs incidental to the acquisition. So these are costs associated with the acquisition of the assets. Then the legal fee to seal the transaction was 12,000. It also incurred a fee of 19,000 paid to Messrs. Opac and Co. Chartered Surveyor. Then the block of flat was sold for 2005 for 2 million. All right, so how do we get the capital gains tax for 2005? Because that's the year it was sold. Now let's see it here. Sales proceeds, we say it's 2 million. Cost of acquisition, 1,250,000. Now there are other costs that came with the acquisition. We have uh, this 65,000 is incidental costs to the acquisition is 65,000. We have legal fee to see the transaction 12,000, and we have surveyor's fees 19,000. Everything given to us are allowable. So when we add these three things here, we have 96,000. And when we minus it from, let's do it together. Let's add those three things together. 65,000 plus 12,000 plus 19,000. And we have this 96,000 we have here. We have to remove 96,000 from the, okay, we are adding 96,000 because all these ones are allowable expenses. We are adding this 96,000 to this cost of acquisition to get all the things that we are going to allowable expenses. So we add them together. We have 134, 1,346,000, which is what is here. It's supposed to be here. So all the allowable expenses is 1,346,000. If we were to take them away from, if we were to take them away from, sorry, 2 million minus 1,346,000, and that gives us, what did I do? Sorry, I'll do it again. 2 million minus 1,346,000 646,000. I have 654,000. Now, by the time I multiply this by 0.1, which is 10%, I have 65,400. So that's how we treat scenario one. Now let's look at the next scenario here. The next scenario is partial disposal of an asset. What does it mean? It means that you bought an asset as one. Let's say you bought a land. You bought one full land. And when you want to dispose, you didn't dispose the whole land, you dispose some plots of land. But when you bought them, you paid a full amount of money. But when you are disposing it, you are disposing parts. That's why we call it partial disposal. So the problem is, how do you determine the cost of acquisition of the parts you are disposing? Because when you were buying them, you bought them as one and you paid one full lump sum. As you are disposing the asset, you need to determine the appropriate cost you will apportion to that part that you are disposing. Now, there is a formula for that. The formula for the cost of acquisition for the part you are disposing is A multiplied by C all over A plus B. That is the formula. A multiplied by C all over A plus B. Now, A is the value of the part that you are disposing of. Then B is the market value of the part you are not disposing. So it means A is the value of the parts you are disposing, the market, the value of consideration, how much you collected for that part, or how much is that part valued at. B is the market value of the parts that you are not selling. Then C is the original cost of the whole asset. That is, how much did you buy the whole asset when you were buying them as one. Okay, so when an examiner is testing you for partial disposal of an asset, he is testing you whether you can remember this formula and whether you can apply this formula for partial disposal. Now let's see how we can apply this. Look at example 4. Lazarus Company purchased the following assets. Now look at the date of acquisition, 1st of April 2001. The asset is a plant and machinery. The amount is 1,200,000. So that's the original cost of the asset. You now see the word part of the plant and machinery was sold. So this is a partial disposal. And it was disposed on December 31st, 2005. The year 2005 becomes the year relevant for capital gains tax. And it was disposed of for 1,850,000. Now, that is the value of the parts disposed. The value of the parts disposed is 1,850,000. Now, this is the A. So that part you are disposing of is called A. How much did you dispose it for? 1,850,000. So 1,850,000 becomes your A. The company spent 250,000 as expenses incidental to the sale. So it means that when it sold it for 1,850,000, it needs to remove that 250,000 from it because it made expenses before it acquired that 1,850,000 as cash for disposal. The market value of the remaining parts, plant and machinery, was 750,000. So as you are selling a part of it, you would have called a valuer. A valuer will value the whole asset. Even though you bought it at an original price of 1,200,000, a valuer will value it at market price for the date that you are disposing it. Then you tell the valuer, okay, this is the part I want to dispose. He will minus the remaining, he will minus the part that you are disposing it, and the remaining assets that you are not disposing, he will give you the value of that side. So that is what we got here as 750,000. The part that was not disposed, that becomes your B. So we now have our ingredients. We have the three things we need. We have A, we have B, and we have C. Now you are told to compute one, chargeable gain on the assets sold. B, the capital gains tax. And C, the new cost of the remaining assets. Now let's see how we can deal with this. Let's deal with it now. All right. This is the solution here. We received 1,850,000 as our cash on disposal. Then we were told that 250 was incidental expenses to the sale. So we are removing 250. Let's be doing them together. We have 1,850,000 and we are removing 250 from it. That should give us 1,600,000. Now this is net proceed on disposal. So this part is determined. Now we need to find the cost of acquisition on that part you are disposing. And we have this formula: A times C over A plus B. Our A is 1,850,000. Our C is this 1,200,000. Our A again is this 1,850,000, while our B is 750,000. So what do? We have A 1,850,000 plus, okay, times 1,200,000. That will give me two, I don't want to call this figure, 2,200 with 9 zeros. Let's take it like that. 2,200 with 9 zeros. Let me copy this for copying sake. Now we'll come here, 1,850,000, which is our A again, plus the part not disposed, which is B, 750,000. That gives us 2,600,000. 600. So I will come now, 2,600,000. I'll recall that. This is the first one we had, numerator divided by 2,600,000, and that gives us 853,846, which is what we got here as our cost of acquisition. So you have seen how we calculate the cost of acquisition of that part. So you imagine 1,200,000 was the original cost of all the assets. But now that part you disposed of, which you sold for 1,850,000, the asset, that just that part is valued, the cost is valued at 853,846. So that's it. Once we get this, we are removing this from our net sales. So let's copy this now. We will now say 1,600,000 minus this our cost of acquisition. We have 7,000,000, yes, 7,000, 46,154. Now when we apply a 10% on it, we have 74,615. Now we have calculated two things here. We have calculated capital gains before we apply tax on it, because the question says the chargeable gains on the asset sold. That's this. Then the capital gains tax is when 10% has been applied on it. Now, what is the cost of the remaining assets? The cost of the remaining assets is simply your original cost minus the cost of acquisition of the part that you have sold out. So this is the cost that was bought. This is the cost of the part sold out. The difference will be the cost of the part remaining. Now this is the original cost of the part remaining. Meanwhile, this is the market value of the part remaining. We are not asking for the market value, we are asking for the original cost. So when you hear the word cost here, it is original cost. When you hear the word value, it is market value. So in our calculation of A times C all over A plus B, A is how much you receive in cash. C is your original cost of acquisition. B is your market value of the remaining assets. So take note of all of these. So that's for partial disposal. Let's look at another example of partial disposal. Mr. Ejiro bought a piece of land at Mokola, Ibadan for 280,000 in 1993. Now the cost of acquisition is 280,000. Of course, by now we know that. And because of the swampy nature of the area, he had to spend 100,000 to put the land in proper shape. So this 100,000 becomes improvement cost. In January 1997, Mr. Ejiro sold part of the land to his brother Osas. Now, he sold part. Now, 1997 becomes what? It becomes the year of relevance. for chargeable gains. Now, Mr. Ejiro sold part of the land to his brother Osas for 180,000. And in September of the same year, another portion was sold to someone unknown for 120. Now, let me tell you something. In taxation, there is something called related party transaction. There is also something called transactions at arm's length. Now, when you are selling or dealing with a relative, a relative, this arm's length principle is usually not followed. So the significance of mentioning brother here is to note that arm's length principle may not be followed. It is possible that this 180,000 that was sold to the brother, it was at a giveaway price. And you see here, the tax people will not find it funny when you are selling an asset that should yield capital gains for the government, you are not selling it below the market price. They will not like it. So it means that they will look at the assets that you have sold out, that assuming you are selling it to somebody unknown, how much would they have sold it? So in order to determine that, they will need to call a valuer who will value that land that you sold to your brother to see whether you sold it at a reasonable price that is supposed to yield capital gains. If you sold it at a lower price than what the valuer gives, the tax people will assume that you sold the land to your brother at the price of the valuer. But if you sell it above the valuer's price, the tax people will say, "Thank you for the good job done. We will use your price." But go and sell it below the valuer's price. They will now come down on you and say, we will take the valuer's price. So the tax people will always favor the higher of the valuer's price versus the price you sold to your relative. They will always take the higher value. So in this case now, on valuation, a professional valuer puts the land sold to his brother at 220. So instead of 180, the people will take 220. While the other was valued at 120. So this one that was sold to unknown was valued at 120. And here you see it here, it was sold to them at 120. So now the remaining parcel of land was also valued at 880,000. All right. Now calculate the capital gains tax payable on the relevant year and by whom. All right, so let's look at this solution. Now, capital gains tax payable in 1997, year of assessment. Now, cash deemed receivable from sales disposal. Now, you can see here, there is the word deemed. When you use that word deemed, another word for deemed is assumed to have occurred. When they say cash has been deemed to be received, it means cash is assumed to have been received. All right. So cash deemed receivable from sales disposal from his brother or SARS, arm's length value 220 as against that 180. So the people are taking it as Mr. Ejiro must have received 220. We don't want to know whether you told us or there's a record showing that you received 180. That's not our business. 220 is what we are taking. Then from the unknown person, 120. When we add these two together, we are getting our 340. Now that's the cash received from disposal, deemed to be received from disposal. Now let us look at the cost of acquisition of the asset. All right. Now, cost of acquisition of the asset, how much was it acquired for? This is for 280,000, right? Now we have 280,000. But mind you, only a portion was sold off. Now, I want you to listen carefully. 100,000 is cost of improving the asset. Now, this 100,000 was used to improve the whole asset before it was disposed of. Take note, this 100,000 is not used to dispose, it's not used to improve the parts that was disposed of. It was used to improve all the assets before it was sold. And so before we do our calculation, we need to add the cost of improvement of all the assets to our cost of acquisition before the formula can be applied. It is a different ball game if the 100,000 was used to improve the side that was disposed of. And in that case, we will not be adding it to the 280 because the 100,000 was only used for the part that was disposed of. But in this case, 100,000 was used to improve everything. So we need to apportion how much improvement cost should go to the part that was disposed of. So we are adding the 100,000 to the 280, we are getting 380. So this is the total cost plus improvement on all the assets. Now, the part that was disposed of, how do we calculate it? This is what we will do. The part that was disposed of, how do we calculate it? Our A is this 340 that we received. That's our A. So we come now, 340,000. This is the value of disposal multiplied by the total cost of acquisition, which is 380,000. Wow. And we are getting this mighty figure. All right. I'll copy this figure because I'm going to use it. Now, let's look at the denominator. 340,000 is our A. Our B is the part that was not disposed. It was valued at how much? 808,000. So that's why we have 880,000 added to it, 880,000, and we'll get 1,220,000, 1,220,000. So I'll come back here and bring the first one divided by 1,220,000, and I have 105,902, which is what I got here when we round them off. If you multiply that, okay, so this is, you're not multiplying. So this is your cost of your assets, 105,902. So you can see it here is the cost of acquisition of the parts disposed. Now, by the time you remove it from the arm's length value of the cash received, so we have 340,000 minus uh, minus 105,902. You have 234,098. That becomes your capital gains tax. And when you multiply by 0.1, you have 23,410 when you round them off. And so that becomes your capital gains. So at this point now, I would like us to ask question if we have any question. Okay, maybe by the time I do example 6, after example 6, we can ask our question before we move to the next scenario. Look at example 6. Mr. Durodola acquired two properties, A and B, in Lagos on January 1, 1980 at a cost of 4 million. That's property A cost 4 million and property B costs 5,750,000 respectively. He lives in property A. So what it means is that property A is where he lives in, and it is not for commercial purpose. The part where he lives is not for commercial purpose. So in March 2004, he used 1,250,000 to convert a part of his dwelling house into a self-contained flat and sold it to his younger sister for 1,650,000. Now, don't be fooled by any story after that is said in property A. Some people might be confusing themselves to think that this 1,250,000 is improvement cost. Yes, it's an improvement cost, but it's not relevant to capital gains tax. Yes, he converted it to a self-contained, but he sold it again to his younger sister. Someone might be thinking, because I mentioned younger sister here, you want to be looking at the market value of what he sold to the younger sister to use arm's length value. It doesn't matter what is sold to the younger sister. The younger sister is also using it for a dwelling place. So capital gains tax will not be applied on A. Now look at part B. Property B consists of two detached bungalow consisting costing 5,750,000. Now he's not living in there. He sold one of the bungalows to his elder brother for 3,150,000 also in March 2004. Now, because that property B is for business purposes, what he sold to his elder brother is relevant and will be considered. Now, because elder brother was mentioned, you will need to check the market value of that property B. That's one of the bungalow. You need to check the market value if what was sold to the elder brother is equal to or higher than the market price. Now look at the next part. The market price of the apartment he sold to his younger sister at the time of sale was 2 million. Okay, so he sold to the younger sister for 1.65 million, but the market price is 2 million. That 2 million market price and the 1.65 million market value sold, they are not useful for us. So as we are checking, you just be checking them back. Now, while the price of the bungalow sold to his elder brother at the time of the sales was 4,375,000. Now, that's relevant. If you check it, the brother was given the bungalow for 3,150,000, whereas the market value is 4,375,000. You are going to take the market value and ignore what is sold to the elder brother. Now, he used 975,000 to refurbish the bungalow before sale. So it means that that bungalow, that part that was disposed of, that part alone was refurbished for how much? 975. Now, this is different from what we solved before, whereby there is an improvement cost for all the land before it was disposed. Now, this one here, the 975,000 was specifically used for the part that was disposed. So when we are calculating our capital cost of acquisition, this 975 will not be included. Now, it goes again to show that the market price of the unsold bungalow, that is the part, because they said property B contains two detached bungalow. One was sold to elder brother, one was not sold. That part is at March 1 is 5,500,000. Now you are required to compute the capital gains tax payable by Mr. Durodula. How do we calculate this? I have told us part of the elements involved in the calculation. Now look at property A. Property A is a dwelling property and not acquired for business. Hence, no CGT or capital gains tax is chargeable. That is simple. So do not just say you are going to ignore property A. You are going to make this kind of comment in property A, and that solves property A. For property B, cash received from disposal of part of the asset is going to be at market value. Since the market value is higher than what was disposed to the elder brother, market value happens to be 4,375,000. Now, the question is, what is the cost of acquisition of that part disposed? Now, the asset was disposed at 4,375,000. That is why we have this thing here as A up here, and we have it here down as A. The original cost of the asset, the full asset, is 5,750,000. That means property B as a whole. This is what it costs. That is what it says here. All right. Now, the part of that asset, the market value of that part that was not disposed is 550,000. That's what we were told here. Now I'm going to do this calculation slightly different. I will start with the denominator because it's easier to start with this denominator. So I will come 4,375,000. I will add it to 5,500,000. I will add them together. I will have 9,875,000. I will copy this. It's easier. Then I will go to the top and I will do the top. Now what do we have? 4,375,000 multiplied by 5,750,000. And now I'm going to get a large figure like this. That's fine. But instead of me copying this large figure again, I'm coming to redo it. I will now say divided by the denominator that I have copied before. So divided by, I will now paste this one here, divided by the denominator I have copied before. When I do the equal to, it's giving me 2,547,468, which is what we got here. So this is my cost of acquisition of the part disposed. So this is the cost of acquisition of the part disposed. Now, the cost of refurbishing the part disposed, we were told that before he sold it, he refurbished it at 975,000. So we are going to add that 975,000 to the part of the asset, the cost of acquisition of the part that was disposed of. And we have 3,522,468. I'll copy this one now. What is our asset disposal received? Okay, instead of copying, I can just say this minus here, and I will say plus 4,375,000. So I will say this minus this, and it's going to give me 852,532. That is my capital gains. When I multiply by 0.1, I have 85,253 as my capital gains. Now that's the capital gains tax. So remember here at this point, the assets was disposed of in parts. And the question helped us to know that the asset was disposed of in parts. One thing that is sure here is part of the asset is remaining with the owner and part has left him. The trick here is to calculate the cost of acquisition of the part disposed. All right, now that we know scenario 1 and scenario 2, it's time to ask your question. If you have any question on this, any of these parts, either scenario 1 or scenario 2, please, we would like to hear from you. I'll give us 30 seconds to see if you have any question. Then we'll continue. Okay, I can see that there is no question. Let's go to scenario 3. In scenario number 3, we are looking at full disposal of an asset. Now, it means that it shared a characteristics with scenario number one. Scenario number one is full disposal. Scenario number three is full disposal of an asset, but there is a condition. The asset was acquired under hire purchase. Now, why is that a problem? When you acquire an asset under hire purchase, it means that you will be paying interest whenever you make a payment. It means you are making equal installments whenever you are making payments. And for this purpose, as you are making equal installments, you are making capital payments and you are making interest payments. But look at it now. Capital payment is being made, interest payment is being made, but we're looking for capital gains when you sold the asset. So it means interest payment should be removed from whatever you were paying. It means that whenever you make your installments, your payments, it contains capital elements, it contains interest elements. We need to know the interest element so that we can remove it from the total payment so that only the capital element is remaining. That's what we are going to do. The cost of acquisition is the capital payments of your installment. And to make it worse, you sold the assets before you finished paying for your hire purchase. If you have finished paying for your hire purchase, that will not become a problem. But because you are still under the hire purchase period, you have not finished settling your hire purchase, you sold the asset. Now, that becomes a special case that we're going to consider. Let's look at one example here, which is example 7. Meltdown Construction Company purchased a bulldozer on hire purchase on February 1, 2007 and paid a sum of 28,500,000 naira as deposit on the purchase price. So that means the purchase price is given as a particular figure, but as part payment, initial deposit, you spent 28,500,000 as part payment on the purchase price. The purchase price is also called the cash price. The cash price of the bulldozer at the time of purchase is 45 million. So it means that out of 45 million, the company paid 28,500,000. And you'll be telling yourself what is remaining after the company paid. Let's see what will remain. 45 million minus 28,500,000. It will be remaining 16,500,000, right? That's fine. Okay. Now, the problem is this. Because you are not paying cash at the time of payment, you only made a deposit. The company was allowed to pay the balance in 20 monthly installments of 1,000 1 million naira each with effect from March 1, 2007. Now, look at this thing now. Normally, this is the remainder of the cash price, 16,500,000. But now they said you have to pay the balance. This is supposed to be the balance, 16,500,000. But they say you have to pay the balance in 20 monthly installments of 1 million naira each. So if it means that 20 times 1 million will give you 20 million. So instead of 16,500,000, you are paying how much? 20 million. So what's the difference? 16,500,000 minus 20 million, 3,500,000 becomes the 3,500,000 becomes the interest that you are paying, because 16,500,000 is the capital that remains on the cash price. The extra 3,500,000 is interest that you have been paying whenever you paid the deposit. Okay, so it is not as simple as that, because look at the question goes on. You are supposed to start paying this monthly installments from March 1. So what happens here is this: the law of capital acquisition on hire purchase follows what they call substance over form. What is substance over form? When you are making hire purchase, you are not the owner of the asset until the asset is fully paid and you are given the title. But who enjoys the asset? It is a man who has the asset in his possession. And so when you are entering the asset in your books, even though you have not paid everything, you are paying hire purchase, you are recording it at cash price in your book. And since the asset is being enjoyed by you, the asset is seen to be yours. So whatever you are paying, the interest element should be removed in order to maintain your cost of the asset. But now let's look at it now. You sold the asset before the date that you are due to make your complete payment. So that means for all the payments that you have been paying over time, you have to calculate the cost of the assets for all the payments that you've made so far before you sold the assets. Now look at it now. You are required to calculate the capital gains tax for the relevant year of assessment, assuming the bulldozer was sold for 48,400 after the payment of the installment on December 3, 2007. Then we have 49,000 after the payment on September 5, 2008. Then we have 50,500 after the payment of installment on October 1. These are the three different scenarios that plays out. Let's see how we're going to solve this. Now there is a pattern for this. Now look at the first one here. The sales proceed is 48,400,000, which is the sales proceed here, 48,400,000. What is the cost of acquisition? This was not given to us. It was worked out. So we'll go to workings 3 and get that figure out now. Let's get to workings 3. Before we get to workings 3, we would like to go through workings 1. In workings number 1, you need to know the higher purchase charge on all the monthly payments. How do we get that? Look at the initial capital payment you made on February 1. That initial deposit is a capital expenditure. every of it, the 28,500,000. Now, this is what you've paid on 1st of February. Now, from beginning of March 1, you are expected to make 1,000 1 million naira every month for 20 months, right? Which gives you 20 million. This is all the money that is expected to come into their that is expected to leave your account to the higher purchase, the person who owns the asset that is selling it to you, which is called the lessor. You are the lessee or the hiree. Now, it means that this is your first payment, this is your 20 monthly installments. Every expected cash is 48,500,000. All right. So this is all the cash you ever pay. But how much is the cash price? The cash price, which is the cost of the assets, as at the date you entered into the purchase agreement, is 45 million. So you remove 45 million from 48,500,000, and we got 3,500,000, which we calculated before, as our finance charge, which is the interest charge. Interest charge. And for how many months did we pay interest? We paid interest for 20 months. So this 3,500,000 represent the accumulated interest we accumulated for 20 months. How much does 1 month interest is? 1 month interest will be 3,500,000 divided by 20 months, giving us 175,000 interest per month. That is workings number one. Workings number two, we are calculating the capital payments made each month. Capital payments made each month. Now we have here, every month we are expected to pay 1 million naira every month. Now, for a particular month, you've paid the 1 million naira, right? Now, what it means that this 1 million naira contains two elements. It contains interest per month of 175, which we calculated here. When we remove 175 interest from what we paid as our monthly installment, it means that the capital element inside this 1 million, the capital part of it is 825, whereas the interest part of it is 175. Now, we are not interested in the interest part of it. We are interested in the capital part of it because we are looking for capital gains when we dispose the assets. So this 825 becomes relevant for us. Now let's go to workings 3, which was relied on. How do we get the cost of acquisition? The asset was disposed of when? On December 3, 2007. Okay, mind you, capital, these installments started being made from March 1, 2007. So let's see. Now, what happened? Initial deposit is always a capital payment, 28,500,000, and that's it. Now, monthly capital payments, if you count from March 1 to December 1, you have 10 payments. So you paid on March 1, April 1, May 1. You will have to count that March 1. So up to December 1, mind you, the asset was disposed of on December 3. So that means you must have paid your December 1 money. Now, you paid 1,000 naira each for 10 months. It's like 10 million. But remember, we have removed the interest. And so we are going to be taking only the capital aspect, which is 825,000 naira. multiplied by 10 months, it gives you 8,250,000. Now that is the capital costs that you have paid up to the time the asset was disposed of. So what will happen is, by the time you add this 8,250,000 to this initial deposit, you have 36,250,000 as your cost of acquisition as at December 3, 2007. So that's what we have here. When we remove this cost of acquisition from the sales disposal proceeds, we are left with capital gains of 12,150,000. 12,150,000. Forgive me, the thousand did not enter. It's a typographical error. The thousand should have been recorded. Okay. Now, when you apply 10% of it, it means you are paying 1,215,000 as your capital gains. All right. Looking at the second part of the question, we have assets being disposed of at 49,600,000 after the payment of the installment on September 5, 2008. So what happened? September 5, 2008, this is the cost of the acquisition. We are told to look at workings for. Of course, this is the amount that it was disposed of. This is the amount we received. But let's go to workings for and see workings for. In workings for, your initial deposit of 28,500,000 is brought here. Now, monthly capital payment from March 1 to September 1 is 19 months. 19 months. So you see, this is still higher purchase. You are supposed to pay 20 equal installments. And now we are using the capital payment 825,000 instead of 1 million. And now we have supposed to have 20 installments, but now we have paid for 19 installments. One more month to go, and we sold the assets. So we need to calculate the capital payments for that 19 months. So when we calculate it, it gives us 15,675,000. Now, when we add this to the initial deposit, we have 44,175,000. And that's what we'll use here. 44 million. Where is it again? 44,175,000. When you remove it from 49,600,000, we have 5,425,000. And when we apply a tax of 10%, we have 542,500. All right. Now, in the C part of the question, look at what happens after the payment of installments on October 1. Now you dispose it at 50,500 after you're finished paying on October 1. Now look at it again now. Look at the cost of the assets. Look at the cost and the amount you received on disposal, 50,500. Now we are told for cost of acquisition, look at workings 5. Let's go to workings 5. Now, initial deposit is 28,500,000. Monthly capital payments, sorry, this should be October 1. October 1, not September 1. And now that is for 20 months. Now, when you add when you multiply this capital payments for 20 months, you got this 16,500,000. Now, can you remember 16,500,000 we did in our calculation here when we said our cash price minus initial deposit gave us 16,500,000? Remember that. Now, when we add this 16,500,000 to our initial deposit, we got 45 million, which is our cash price. This is our cash price. So if you look at it now, it's our cash price that we are looking at. Look at it now, cash price, 45 million. That is what we also have here. And so when we disposed of this one, we remove the cost of acquisition from the proceeds, we have 5,500,000. Tax is at 10%, which is 550,000. Now, something you should note here that in number C and number B, the year of assessment is 2008 because it was sold in 2008. But take note of C. In C, all the higher purchase has been satisfied. And so C is no longer higher purchase because you have finished paying. How do we know it's no longer higher purchase? Because your cost of acquisition is equal to your cash price. So whenever your cost of acquisition is equal to your cash price, you know that you must have finished payment of your higher purchase and you are not dealing in higher purchase conditions. So this part number C is the same thing like scenario number one when the asset was fully disposed of. You know, in part C, we acquired it in higher purchase. But because in part C, we have finished paying, higher purchase conditions does not affect us. But in part A and B, higher purchase affected us because we were calculating the cost of the assets up to the point when we sold the assets. How much have we contributed or we paid for the assets before it was disposed? So I guess we understand what we've made here. All right. So that is for part C, the third scenario. In our next class, we are going to look at scenario number 4. Now, this is one part that I can usually set. One of the favored parts of capital gains tax that I can usually set is scenario number 4. So we shall take our time and look at it. Then we shall do a little review on scenario number 3 because I can also set scenario number 3, but most times they set scenario number 4 as the most favorite, followed by scenario number 3 before scenario number 2. So in our next class, which is going to be on Wednesday, we are going to look at scenario number 4. So at this point, if you have any question to ask, you can send me a WhatsApp message or send me an email. Later, the recording of this class and this material will be sent to you so that you can digest it. So thank you so much for coming to class. I look forward to seeing you in our next class. So at this point now, the class will be ending. Thank you so much.